It's called the One Big Beautiful Bill, but is it going to be beautiful for investors? Let's dig into the budget deal that recently passed the House of Representatives and talk about what it might mean for your money. So before we get started, I'm not going to break down all of the details of this bill. I'm going to leave that to other commentators out there. I'm a professional investor, so I'm going to focus on how this bill could impact financial markets. I'll also say that we're recording this on May 29th. The bill has only passed the House. It's very likely to go through some serious changes before it ultimately passes the Senate. So for this conversation, I'm going to focus on what we know from looking at the House bill. Maybe I'll do a little bit discussion at the end on how it could change when it gets to the Senate. Let's start with tax cuts. So the bill does two big things related to tax rates. There's a few minor things that are in there too. First, it extends the tax cuts that passed during the Trump administration back in 2017. Those were set to expire at the end of this year. So it ultimately would have functionally created a tax hike. So essentially, this means that the basic structure of tax rates for individuals will remain the same for the foreseeable future. From an economics perspective, had the tax cuts expired, that would have been a negative, at least in the short term, for consumer spending. But as it is, this really isn't a change from the current environment, and so not something that markets were super focused on. It was basically assumed that the moment Trump got elected, that this extension was very likely to happen. So in addition to that, the bill also cuts or eliminates taxes on some Social Security, tips, as well as overtime payments. Generally, the households that benefit from these cuts are what economists call high marginal propensity to consume households. And all this means is that if these households get an additional dollar of income, they're likely to spend most, if not nearly all of that dollar. So to use an example, if a waiter gets to keep just another dollar of his tip money for himself, if he's high marginal propensity to consume, he's going to wind up spending most of that money. So from a broad economy perspective, this means that this tax cut will have something of a stimulative effect on the economy, because those dollars are going to flow through the economy relatively quickly. Could also have a bit of an inflationary impact for the exact same reason. Now, although this budget does envision some spending cuts, they fall well short of paying for the tax cuts. So it's estimated that this bill, if it were to pass as is, would add something like $300 billion to the deficit per year over the next 10 years. There are a couple complications to this, though. There's something called dynamic scoring. This is basically the idea that tax cuts might spur higher economic growth than would otherwise be, and that could result in sort of ameliorating the impact of tax cuts on revenue generated by the government. So, for example, the Tax Foundation estimates that the tax cuts would reduce revenue generated by the Treasury by about $4.1 trillion over the next 10 years on a static basis. However, when they use dynamic scoring, in other words, when they sort of make some assumptions about how economic growth might improve with these tax cuts, that number drops down to only $3.2 trillion. So there's a $900 billion improvement in revenue generation strictly because of better economic growth. Now, the tricky thing is there's a lot of assumptions that go into that kind of estimate, and the reality is just very unlikely to quite match those assumptions. Now, the other big complication to estimating the impact on the deficit is tariffs. So President Trump talked expressly many times about using tariffs to partially replace the income tax. So since tariffs are separate from this bill, those were all implemented by Trump directly. This bill is about, sort of more traditional taxes going through Congress. that the tariff revenue isn't considered when they're talking about how much this bill will impact the deficit. So basically, if you're reading a news article about how this bill will increase the debt, it's sort of ignoring usually the tariff impact. Some Trump officials have claimed that the tariff revenue could make up entirely for any shortfall coming from these tax cuts. And I would admit that's certainly a possibility. The problem here is that tariffs are extremely hard to predict in terms of the revenue generated. Consumer behavior is almost certainly going to change based on the price changes that come from tariffs. And so that means that we're almost certainly going to have fewer goods imported in a world of tariffs than we would in a world of freer trade. And if that's true, then that's going to change the amount of revenue generated from the tariffs. And that's on top of the extreme uncertainty about what the tariff rates will actually be. Not only is Trump currently negotiating tariff deals with various countries, but there's also been legal challenges. Recently, the Court of International Trade ruled that Trump could not use a national emergency to impose tariffs unilaterally, and that was the sort of vehicle he used when he enacted the reciprocal tariffs that were announced on Liberation Day. So now the White House is appealing that ruling, and so it's possible that on appeal they regain that power. And the White House could also use other avenues to enact tariffs as well. But point being that the revenue from tariffs generated is extremely uncertain for a wide variety of reasons. The next thing I want to talk about is interest rates. Now, you may have heard Moody's Investor Service downgraded the U.S. Treasury's credit rating recently, citing the apparent unwillingness of Washington to lower the deficit. And that downgrade itself wasn't especially important for markets for several reasons, but the issues raised by Moody's are definitely relevant to this conversation. As many of you probably know, I spent a good chunk of my career as a bond guy, and for almost all that time, the bond market really didn't care about the deficit. I would get asked about it all the time, and I was like, the market doesn't really care. But that has definitely changed since 2020. It's becoming noticeably more common that news about the debt or the deficit moves the bond market materially. And by extension, it's pretty clear that interest rates in general are higher than they would be if the size of the US debt were even modestly smaller. So to be clear, I'm not an alarmist about this. I don't think the US is anywhere near some kind of point of no return on debt. I also don't think that any serious global investors are actually worried about getting paid back when they buy treasury bonds. Rather, the reality is that the treasury just has to sell a very large amount of new debt every year to fund this deficit that we have. And it's just taking a higher interest rate to entice enough buyers. And the larger the debt gets, the more this is going to be true. Now, all else being equal, high interest rates make it more expensive for people to buy houses or for businesses to invest on expanding, et cetera, et cetera. And so while it's true that the tax cuts I described previously probably will have some stimulative effect on the economy, if interest rates stay this high or even go higher, that could be something of an offsetting factor. Now let's turn quickly to the Senate. As I said above, there's a very good chance this bill changes substantially once it hits the Senate. Already, several leading Republican senators have criticized various elements of the bill, most commonly that they want to see a smaller deficit, but we even have some, like Missouri Senator Josh Hawley, criticizing the spending cuts out of Medicare in the bill. And so Republicans only have a 3-seat advantage in the Senate, meaning that even a small number of detractors could sink the bill entirely. How exactly they will find middle ground remains to be seen. It does appear that at least some in the Senate are paying more attention to interest rates, Florida Senator Rick Scott and Wisconsin Senator Ron Johnson both very recently mentioned the bond market in expressing concerns about this budget bill. So I would say that we should be prepared for some budget drama this summer. So while Republicans certainly have a lot of incentives to get some kind of bill passed, otherwise there winds up being a tax hike, as I mentioned before, it's not at all clear that the big, beautiful bill that passed the House can also pass the Senate. But hey, let me know what you think. Are you more worried about the deficit than I am? Put a comment in the comments section. I'll be happy to respond to anything I see there. And if you like this content, it'll be coming at you about once a week with reactions to news, things coming out of the White House, things coming out of the Fed, ideas about investing. So hit that subscribe button. You'll be the first to know when we've got a new video out. I'd love to see you again.